Check. Hi everyone. Can you finally see and hear me? Okay, great. I don't care about I don't much care about if you can see me, but it's necessary to hear me and see the slides on your screens. So is everything fine right now? We can start. So, okay. So, so far, we've been dealing with the situation when we know the distribution of the P&L. So technically, it means that someone developed the model for us and we just used it or see the results of its application. And we dealt with this distribution so we could um, calculate some risk metrics, so we can find out if those metrics perform the way we expect them to perform. Run back testing and validation process. But now the problem between in front of us is to identify the framework and algorithm and formal methodology that will allow us to come up with the distribution itself. All right. So now the actual modeling comes on the stage, and we go into look at this process regarding two kinds of risks: market risk and credit risk, because they are internally different. We can think of market risk as a continuous kind of process because we can observe fluctuations of the prices or value of the portfolio or some positions um, on a very short time span. So, for example, if we concern about daily revaluation of the portfolio, we can daily oh, I lag. Okay, how about I turn off my video? So let's care about the voice. So is it better now? Okay. The last part. Uh, can you help me with the starting point, Nikolai? Which part? About the market risk, that is continuous risk, right? Okay. So the difference between market risk and credit risk is the nature of appearing of losses. Okay, so market risk corresponds to the even small fluctuations of the prices. So technically, prices continue um, change continuously, and we can go daily, we can go minute by minute, we can go monthly, whatever it is, and each even tiny change of price causes profit or losses. Um, so-called jump processes. So dealing with the credit risk, most of the time we do not. Are you saying anything? We lost you. Oh, whoa, 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 whoa. Now you can hear me, right? I'm back. And slides are back too. Okay. I'm not happy about the connection, actually. All right, so let's move on and see how it goes. All right, so now we're going to deal with the market risk, and we're going to consider some basic algorithm and a basic methodological steps that any process of modeling will involve. All right. So I start with definition of the market risk. So it's kind of easy to understand that market risk associates with potential losses um, occurred from changes of market factors. When we talk about the market factors, we actually speak about some market indicators that arises from the trading and any other sort of market communication. So here is a list um, of potential market factors. You can see stock prices or indexes. Okay. Gregorio, is everything fine? Did I switch the slide? Okay, okay, good, great. All right. So interest rate, currency rates, commodity prices, even volatilities that can be considered as a parameter for option pricing, for instance, and many others derivative contracts. So all of those values can be considered as a factor of value of different some other instruments like other stocks or probably bonds or probably commodities or some sort of derivative contracts. And when those market factors change, these changes result in changes in our market portfolio and may bring us losses. So we actually care about this possibility, all right? Um, Basically, we need to form some kind of portfolio. So we need to select some assets and financial instruments. We need to construct a portfolio. So we need physically to obtain them in desired amount. We also need to identify the horizon of holding this position. Um, and when I say horizon, I mean the horizon for entire strategy. So how much time I'm going to deal with this portfolio and probably reconstruct that in a manner um, I can identify regardless of the risk. So actually, I can not only hold the position for the entire during the entire period of time, but I also can restructure it somehow. So I can rebalance it actively. The only condition that the only condition that should hold is that the strategy should be predictable. So I need to be absolutely sure what to do, regardless of what happens around. Okay. So there should not be so uh, there should not be any risk corresponding to the strategy um, as a source of risk. So I should be pretty sure about the strategy. So even each step that I take should be determined by the dynamic of the prices. Okay. So now let's take a look at the structure of the portfolio risk. So we have the range of assets. Um, Here we're going to deal in this course with stocks, bonds, and currencies. So you can see the notations. So as the letter S stands for stocks, B for bonds, FX for exchange rates of currencies. And these three types of instruments we're going to deal in this course. Other instruments like commodities and various derivative contracts we're going to keep outside of the course because those instruments actually deserve the discussion in their own course. All right. So this is a notation. We're going to denote this way prices of the instruments that we consider. Now we're going to talk about the portfolio structure. All right. Technically, talking about the portfolio structure, we can talk about the quantities. So we can say how many stocks of this company we buy, how many stocks of this company we buy, how many lots we get from the exchange bid here. But at the same time, we actually concern about not the quantities. We concern about shares. So we actually think about how many percent of the entire value of the portfolio corresponds to certain instrument, for example, certain stock. And these thoughts take us to the consideration of the portfolio structure in terms of share values. So here we can see the vector of weights. So for example, W1 as a weight of the first stock in the portfolio corresponds to the number of percent of the entire value of the portfolio determined by the value of this stock. All right. So for example, this is the 5% of or 6%. So for example, if I have $100 investment and first stock constitute $50, so this should be 50%. All right. So the sum of all weights should be equal 1. And that means that we considering only long positions. We consider only long positions obtained with proprietary capital. So you need to have your own money and you have to invest your own money in this portfolio, and everything that is that you're allowed to do is to buy stocks or bonds or currencies. So you cannot go short. Okay. And this condition right here expresses this consideration. All right. We also have a horizon. So when we're going to calculate the return in our portfolio, we're going to apply most of the time arithmetic returns. And as you can see here, if our horizon expressed in days, so the units are days, we need to take price with corresponding lag to calculate the return, right? So in this particular case, to calculate return, we have to take current price and divide it by price H days ago, all right, in order to calculate the financial result. Okay. So chat is silent. All right. Now let's move on to the algorithm itself. So these steps that we have to do before everything that we've done previously in this course. All right. So we need to, first of all, we need to identify risk factors. We need to determine how many of those factors we can find and include into the model. Um, and what those factors actually are, because in practice, um, it is very unusual and untypical to include factors artificially obtained. So they actually need some sense and should be interpreted economically. All right. Then we need find the distribution for individual risk factors. So this is kind of fitting problem of distribution, and you're already familiar with this. After that, we need to identify dependency structure among the factors, because those factors may be correlated, they may be independent from one another, and the degree of dependency is very important when we calculate risk for some particular problems and decisions. So, for example, if we concern about diversification, actually we need to identify those factors that are independent from one another. If we concern about hedging, we need to find factors pretty close correlated. When we searching for concentration on particular risk factor, so for example, risk policy of our company or some regulatory requirements uh, actually imply that we cannot allow ourselves uh, to expose solely or completely on one factor, or the contribution of one risk factor should be not greater than 50% um, of the portfolio risk measure, something like that. The problem is that dependency may be nonlinear, so correlation may be not very conclusive indicator for dependency. And the another problem and perhaps that's the main problem dealing with the dependency and modeling dependency of the risk factors, that model becomes extremely complex when we include into consideration many risk factors and try to construct their dependency with multiple parameters. Okay, so this is a kind of an art um, to construct the model of the dependency of risk factors, but we're going to deal with this. Okay, after that we need to um, identify dynamic parameters of the risk factors. So we need to find out if the risk factors are autocorrelated or something like that, because it will influence the way our risk measures in our risk estimates will change with extending horizon of risk. Okay. And as a matter of fact, um, the relevant historical data also matters, because um, if we have only short historical perspective, probably we won't be able to identify those properties. Okay, so first four steps um, are concerned with risk factors and their interconnectedness. The last step is the pricing, Actually, this is the mapping of risk factors to the value of the portfolio. That means that we need pricing formula that associates any scenario um, determined by the values of the risk factors to the price of the portfolio. All right. So, for example, if I know what the interest rates are and what the foreign exchange rate is, I definitely should be able to identify the value of my portfolio. Okay. And it involves a lot of techniques. Some of them are very sophisticated and advanced. Um, so the sophistication of the pricing model is determined by the complexity of the instruments in the portfolio that we apply. In this course, we're going to stick to standard instruments like stocks, but we also going to consider bonds, and regardless that bonds are pretty basic instrument, you will see that even that simple instrument may cause some technical issues and may require some sophisticated valuation methods. Okay. No questions so far. Okay. So uh, now let's consider the process of risk factor selections. So what we can do to identify those risk factors. Um, so the first step is pretty simple, so common sense. If you are a professional in economics, in trading, you should have some knowledges, and you should know some economic laws and know some stylized facts. So you should be pretty experienced to come up with an intuition of what may happen and what may influence your portfolio. All right. So this is a kind of heuristic approach. So in order to identify the sensitivities of the P&L of your portfolio, you can use regression analysis. So if you are certain with the number and the nature of your risk factors, and you collect empirical data, so you have numerical material you can work with to identify some quantitative measures of sensitivity or build a pricing model, now you can use regression analysis. Okay. Another way to deal with risk factors is to apply pure statistical methods. The idea is to enable data to speak for itself and let it show you the image of the factors that may drive P&L of the portfolio or a particular stock. So we can apply such methods as a principal component analysis, factor analysis, discriminative factor analysis, many others. And the idea is to construct the image, but usually we don't stop here and use those quantities as a risk factor. So because they're kind of artificial, we just construct them from some assumptions, from some ideas that cannot be validated economically. So when we obtain those results, we actually need some real life candidate that performs pretty closely to those artificial factors. I can give you an example. I'm sure that most of you are familiar with capitalizing asset pricing model, CAPM or CAPM. You can call it different ways. And probably you remember that the factor of any return is a return on market portfolio. So the return of market portfolio is the common factor, is some factor that defines um, dynamics on other returns of other instruments, right? And the what actually we can extract from the data using principal component analysis is that the first and main principal component is very close to the actual market portfolio. So, for example, if we apply PCA for the American stock market, we're going to see in first principal component, so the first factor, we're going to see something that is very close to the returns on S&P 500 index. If we apply the same technique to the European uh, market, we're going to see something very close to DAX. Okay, so that means that dealing with some artificial factors sometimes very useful for building your own intuition. Okay, and another thing that we should consider as a constraint in selecting risk factors is regulatory requirements. Those requirements are very strict, and for example, from Basel Accords, so the Basel requirements for capital assessment, they provide criteria for modelability. So there is a list of signs that demonstrate and justify any model that you can use in a practice. So, for example, if you have some idea about risk factor, but you cannot quantify it properly, so for example, you don't have enough data, or the quality of data is poor, or you cannot validate the results. For example, there is no instrument actually represent market traded on a market instrument that represent the exposure to this factor. Probably you should leave your idea aside and try other factors more economically meaningful. Okay. Could you please repeat some example of risk factors? Absolutely. So, for example, returns on stock indexes. It is one common, widely spread example of risk factor. Another factor, for example, returns on exchange rates. Another example, increments of interest rates. Okay, and we can go on, but that's the list of factors that that is included in practice in all kinds of financial institutes. Okay. Okay. Now let's move on to some formulas. So let's talk about the stock returns, because the stocks are instruments that we're going to consider primarily. Okay, and let's see the way we can calculate returns. So you're already familiar with these two concepts, arithmetic and logarithmic returns. So let me remind you that they are pretty close to each other on short horizons. So when the values of returns are small, they are pretty close to each other and can be considered as an approximation to one another. But these two types of returns have their own individual nice properties. So, for example, arithmetic return is portfolio additive. That means that arithmetic return on portfolio is just weighted average of returns on individual stocks. So as you remember, W here stands for the weight of the security in the portfolio. So it's very easy to calculate the portfolio return if you know returns on individual stocks in the portfolio structure. Um, logarithmic return logarithmic returns have another nice property, is time additivity. It means that if you would like to calculate returns on different horizon, so for example, on a 7-day horizon or a 1 month horizon, and you know all the returns, all the daily returns. So the long-term return is just a sum of sequence of short returns, all right? So this is a pretty easy as well. And it's very useful property because usually we construct our models for the short-term horizons like 1 day because we try to create as much data from our history as we can. And one of the obvious ways to do that is to shorten time horizon. Okay, so we usually construct our models for daily returns, but we also concerned with the long-term risks. So we usually apply short-term models and then we extend it to somehow to longer horizons. That's why we use logarithmic returns for the modeling most of the time. Okay. Another nice property of logarithmic return is that it's unbounded. So actually domain containing all the logarithmic returns is from minus infinity to the infinity. So it can be, logarithmic return can take any value. In opposite to the arithmetic one, because it's bounded from below, because you cannot express in the way arithmetic return is expressed, nothing greater than 100%, right? So if we assume that prices are non-negative, that means that arithmetic return can be only -1, all right? And that's the problem, because if we try to construct some distribution, they might be not very nice. So they might be skewed, they truncated. And that's kind of a problem that makes our model more complex and untractable. And we try to avoid it. That's why we use logarithmic returns for modeling. Okay, let's move on. And here is the problem that I'd like to discuss with you. It is called dimensionality curse, and it actually expresses the fact that the greater number of instruments in my portfolio, the greater number of parameters I need to estimate from the data. And as I have limited history, this is kind of common situation, the enlarging of the portfolio actually corresponds to the poor quality of estimates and the poor quality of the model, because we try to use many degree of freedoms to describe small amount of data, and usually it ends up with robustness problems. So we end up with a model that we cannot rely on and we cannot trust. Okay. Um, and here is the deal. We actually try to identify those factors, uh, those risk factors that will allow us to to deal with fewer parameters. So, for example, as I was saying, uh, it's kind of rational to express each individual return on stock through the finite number of factors. So, for example, I would like to express uh, return on, let's say, JP Morgan stock as a combination of other factors like um, like a like an index return, exchange rates, or something else, maybe uh, returns on some commodities, etc. Um, and those factors actually represent the common ground of the risk factors for all other instruments. Okay, and it allows me to use few risk factors for the entire portfolio, no matter how many factors I have. Okay. Um, it also allows me to identify the internal dependency of the returns of different stocks. Now, all the dependency of the stocks will be determined by those factors that I defined. So, for example, everything I need now is 30 stocks or 50 stocks. It may be a huge portfolio. Um, but common factors, I can identify correlation between those five factors, and then identify sensitivity of the portfolio to these factors. And the result is much easier to obtain and verify in this case. Okay. So one of the way to do this is uh, apply purely statistical methods like principal component analysis. Um, so, for example, uh, I can identify. Oh, let's skip this slide. You can look at this later. It doesn't matter. So here is a picture of application PCA based modeling. So here, for example, I have the structure of my portfolio. Here's a time series of individual returns, and I have n stocks in my portfolio. So applying PCA, I can identify n independent factors, not actually independent, but uncorrelated factors, and identify just some of them as the key factors because they contribute the most to the variance of um, every of variance of the return of every stock. So I can consider these key factors as those factors that I need to model and leave all other components aside because they are negligible, or I can consider them as a white noise or error that individual to each stock. All right, so this kind of residual can be represented uh, by individual errors. Okay. At the same time, principal component analysis can uh, can provide me with sensitivity of each stock to each factor. So, for example, this factor contributes this value to the first um, stock. All right. So this is the sensitivity. So actually, you can see here from this picture, you can see the structure of regression model. Okay, so you have a series of returns on one stock. You see some as an independent variable. You see some factors as a as a dependent variable. You see some factors as independent variables, and you see the coefficients, right? And other residuals that you may model either way you like or you find tractable. Okay. So, for example, dealing with the first factor, you need to multiply this value by this coefficient as a contribution and define the portion and find the contribution of this stock to the of this factor to the first stock. What do you need from where do we from where do we know PCA? Um, you mean like a methodology, Nikolai? PCA1, PCA2. Okay. Actually, the methodology itself, the method, provides you with a decomposition of the factors and the coefficients, so that you should apply to the. So this is what the methods provide you. Don't pay too much attention. I just try to show you that the same concept is applied to the purely statistical method when you reconstruct the factors from the returns of individual stocks, or you apply the same picture, so the same concepts when you apply regression analysis, because when you're doing regression, you know all this data, historical data, and factors are given you as in economic numbers. But when you apply PCA, you try to reconstruct this process, right? So you need some um, okay, Ekaterina, I'll do this next class when we go in to deal with the collab, all right? We couldn't hear you again. Oh, 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 oh. You hear me now? Good. So, but sometimes principal component analysis is very useful thing. And by the way, we can apply it without any economic reasoning because the result actually that is produced by this analysis is very bright and conclusive. So, for example, let me demonstrate you the picture of coefficients So the sensitivity coefficients from principal component analysis of interest rates. I will show you what the interest rate curve is a little later, but the idea is that the uh, coefficients itself um, are um, very useful in terms of uh, the way factors work um, uh, regarding our risk factors. So, for example, um, we can decompose interest rates on different maturities, so having different times to maturity, with the principal component analysis. And what we will find out is that the first component and the first principal factors um, actually represent parallel shift uh, of the rate curve. Okay, so you can see blue line here. It's called level, and what we can see that this line is lies um, in a positive area. So all the sensitivities are positive. So when this factor works and influence the curve, that means that all rates goes up or all rates goes down. So that's why we talk about the shift. The red line is the second principal component. It has less impact on the curve comparing to the first one, but it influenced the curve in a different way. So you can see some of the coefficients here are negative, and they are negative for the short-term rates right here, but they are positive um, for the long-term rates. And that means that this factor will push long-term rates up and short-term rates down. And this will result into the twist of the curve and changing the slope. And for example, if you consider portfolio with the bonds of different maturities, that means that this factor will um, affect different bonds differently. So, for example, if you have short-term bonds, this factor will push their price up while pushing the prices of long-term bonds down. And in this case, it's kind of compensating. All right. So the move of the price of the short-term rates are compensated by the movement of the long-term rates. And this third one is the change of curvature of the curve. Um, it corresponds to the positive coefficients for the middle range terms and negative coefficients for the short terms and the very long terms rates. This factor actually represents the hump on the curve or something like that. So it changes the curvature. And this is kind of cool because as you can see, you have the continuum of the rates actually, right? Because you can see, you can deal with the rates of different maturities. So you may have like a 50 rates, but at the same time, you can represent the entire curve with only the dynamic of the entire curve only with the three factors. One of them pushes curve up and down, another one twists it a little bit, and another one makes a hump, make it flatter or more curvy. All right. it just different risk factors curves, right? Yeah. Okay, let's take a look at some stylized facts on asset returns. Those facts may um, help you to identify right um, distribution to fit. So what we know from one of the influential work by Ramakant in 2001, it's kind of paper that summarizes all stylized facts that we that we know and still actual, and so you can actually read it. It's very interesting and useful. So we know that asset return distributions have tails. So it's kind of naive to think that single instrument will have normal distribution, but still normal distribution works fine for very well diversified portfolios. We also know about the distribution asymmetry. As I mentioned before, there are no return autocorrelation on short time frame, at least at short time frame. So, for example, it's very hard to find any statistically significant autocorrelation on a daily basis. The another prominent fact is volatility clustering. I will demonstrate this effect in a couple slides. And another one is a conditional habit tails. It's just for information. It means that even after applying all the models that can deal with effect of clustering volatility and adjusting returns respectively, the adjusted values still have habit tails. They're not that heavy that initial data, but still it means that basic models that we apply usually cannot fully deal with the habit tails of returns distributions. All right, so here is some example. So this picture represents empirical distribution on exchange rate, so US dollar to ruble, 10 years of historical data, and this data is fitted using two distributions, normal and t-student. And as you can see, the difference is significant. So for example, if we dealing with international portfolio containing international foreign currencies or foreign stocks denominated in foreign currency, and we apply, but we are concerned about value of the portfolio in our domestic currency. So picking distribution matters a lot because value at risk for 99% of confidence level depends heavily on the distribution. For example, for normal distribution, it's about 2.5%, but for student distributions, it is about 3%. So you can understand that this is about 33% difference. This is kind of large. No, not 33, but about 20. No, about 2018, something like that. So, for example, if you would like to associate capital with this measure, it's kind of significant. Okay. All right. Okay. This slide demonstrates volatility clustering effect. And this is the Garch model. So this acronym stands for generalized autoregression conditional heteroscedasticity model. So this model represents uh, the effect when uh, volatility of the series changes and um, and have this clusterization effect. So you can see it. Um, this is the particular specification of the model. Um, we not you don't need to understand it uh, completely or in depth for this course. For your practice, I will provide you with the code. I will just describe the idea of this model. So the model actually describes how volatility of the series, so the standard deviation or variance of the series changes over time. And the idea is that current or near volatility depends on uh, previous estimates of the volatility and square of previous observation. So, for example, if I observe huge loss or huge profit previously, I will adjust my estimation of future volatility respectively. So, if I observe huge losses or huge um, profits, I will increase my estimate of future volatility respectively to the previous one. All right. If I observe small changes of the price, so I will lower my expectation of the volatility. All right. So that means that every day, every period, I reevaluate future volatility. All right. So and it describes and explains why the volatility clustering appears, because um, future volatility, the variance of the series, increases with uh, appearance of the huge observations. All right. Okay. Now let's talk about um, approximation. So usually we have uh, some pricing formula that maps factors to the value of instruments or value of the portfolio. And these formulas may be very hard to implement because uh, it's pretty nice when we have closed form solution and we can solve any equation analytically. But for very complex instruments like derivatives and even for bonds, the pricing may be painful. It may involve some numerical methods, simulation, and any time in many other time consuming and uh, computational power consuming techniques. So, but dealing with the market risk, we actually appreciate speed of calculation. So, for example, exchange calculating the risk of open positions uh, need methodology that can be performed very fast because uh, any order that placed into the stocks, into the exchange, waits until the exchange um, run the calculations on this position and find out if a participant has enough money to cover potential losses, and if it's true, then the position or order is placed into the limit order book and may be used for trading. All right. Um, so what we can do to make those calculations faster and make models simpler. First of all, we can use linear approximations. So for example, we can use Taylor representation for decomposition of the function near some point. And it will provide us with some kind of sensitivity coefficients. And it is common terminology right now to call sensitivity of the first order as delta. So many methods applied today called, for example, delta neutral or delta normal, implying that we deal with approximation, we deal with the linearization of the value of portfolio or instrument. So on this slide, you can see the example of this kind of approach for the single stock when the value of stock describes by exponential dynamic. So that means that we consider as a risk factor. So we consider a logarithmic return as a risk factor. And actually, we can apply Taylor representation here and demonstrate this way that actually dealing with logarithmic returns as arithmetic returns, so this is the formula for arithmetic return, is a good approximation, is a very nice approximation for small values. And as a matter of fact, we're going to do this all the way the course, because this approximation actually not only close, but it's also a conservative one. What I mean by that? I mean, if I consider not exponential dependence between log return and the price, but the linear one, actually that means that I'm in a position of the instrument that is more risky than the actual one. So, for example, if I think that the risk is driven by the distribution of log returns, but I deal with it as a arithmetic return, so I'm considering not real instruments, but the alternative reality where instruments linearly depend on these returns. Actually, it produces distribution which is shifted to the left from the original one. And that means that I consider more conservative distribution than initial one, and I can apply this, and I can be sure that applying all my calculations on this approximation, on this distribution that approximate my original one, I will obtain risk measures that are not less than original one. So I will always cover the risk of actual instrument or actual portfolio. All right, and it will be true anytime when I apply risk measures that are monotonic. So remember from the first lecture that coherent risk measure has a property of monotonicity when I consider instrument that in any case will bring greater loss or less profit than original one. I'm going to calculate, I'm going to see greater risk measure. So for example, value at risk is a monotonic risk measure. So applying value at risk to this approximation will work fine. Okay. Okay. So let's have a break. I think Yeah, I think I ran out of time a little bit. So let's have a break for 20 minutes. You have your rights. So for 20 minutes, and we're gonna start at we're gonna start at um, 11:20. Okay. Yeah, I think it's okay because we have 30 minutes break um, between second and third class. So I think it's okay to have 20 minutes break, don't you think? Okay.